All right, guys, let's move on to next. We've got a gold trade in now. Let's go to Disney. Our big trade of, not our big trade, but our big earnings event of the day. And Disney's got some things going on. First and foremost, Scott Bauer, your views on Disney, what you're looking at pre-earnings.
It looks like the market is expecting about a $5 or so move, I think, about 4.5%.
497, close enough.
Close enough, right there. So when I look just technically at the charts here, there's certainly some support in around the 111-ish area, maybe the 112 area.
Right around there?
Yep, right in there. So depending on what implied vol is doing, and we'll look at that here shortly, and what the IV rank is, that may determine to me whether I would potentially want to sell a put spread, maybe as a backstop to the downside there, using that as some support, or whether I want to look at maybe some upside if volatility is on the lower end. So I really like what's coming out of Disney. I mean, yes, there's some pretty high expectations here. But again, with that backstop around that 111, 112, at least from a technical standpoint, I really look at that and say, okay, maybe I can play off that.
Great place to start is the today's option stats.
Yeah.
Tom White, current IV percentile, 81%.
Yeah,
that
Ryan
tells you it's in the top 4/5.
Yep.
Right?
Yeah, Ryan, go to the platform here, and we're going to kind of point out what Kevin's talking about there. You see the current IV percentile rank at 81%. You see the implied volatility down there close to 29%, so it's towards the upper
range. Show our
range.
viewers where you're getting that from. The top two lines, and then the seventh line down is where it's trading.
Yeah, here's your 52-week high, here's your 52-week low. Here is the IV percentile rank, which is 81%, so that the high end of that, because we see our implied volatility down there at 29%.
So you're about 4 points from the high in vols over 52 weeks, but you're 14 points from the lows in vols. That's showing you that it's at the higher end of the scale.
And think about this, and you guys brought up a good point, that the anticipated market maker move up there at the top of the platform, showing about a $5 move, right?
Let's talk about that, because you've got some historical numbers on it.
Yeah, 2-year average over the last 2 years on a quarterly basis, the average was only about a 2% move the day after earnings. So remember that.
So we're talking about 2.5 times the expected move normally over the last 2 years.
But why might that be? Is because
there's a lot going on.
We've seen we've seen a 17% rally in the shares over the last 2 months. So the anticipation into this report, it's been strong, and the sentiment's been bullish. We've seen calls outpacing puts, and as far as volume goes, by about 3 to 1 over the last couple of weeks. So we've had some movement, some speculation to the upside in this particular name.
Guys, what are we looking at in terms of a trade? It's got. I imagine it's going to be something in the short Vega category. Right, Tom? You said you're looking at an iron condor.
Yeah,
right?
Short iron condor, and that's just because
Scott,
the volatility.
Are you on board with that?
Love it.
Right.
Short, the volatility is elevated in there. And what I did is I went out to the August 10 weekly cycle, which expires in only 3 days here. You can see from the platform.
Short-term trade.
Yeah, I'm selling a 2-point wide put vertical. I'm collecting 40 cents on that. But I want to make it range bound. So I'm trying to go up to that, basically that $5 outside the anticipated move, which would be my anticipated market maker move. And I'll sell the 121, 123. You're collecting roughly 78 cents on that iron condor. It's $2 wide on each side. Your risk is $2, which is a width.
Actually about $1.20, right?
Yeah, about $1.20 on that. We'll put that in at 80 cents just to give us an even number on that. You're risking 120 to make 80 cents on this this particular trade. It's risk defined. Kevin's showing you the risk profile of that particular trade. Break even points about, let's see, on the call side 120, 180. On the downside 111.20 is your break even points on that particular trade. Risk defined takes advantage of high implied volatility with that expectation that volatility will get crushed tomorrow morning.
Right.
And it's a way to play a stock if you're neutral on it.
Scott Bauer, how much do you look at the one-day expected move versus the probabilities? Because sometimes if you go to like the 70 probability, you're inside that expected move.
Right.
Does the one-day expected move trump the probability trade here?
It does for me,
Yeah,
and that's how we teach our clients. It definitely does for me. And then I look at what that expected move is. Look at what the break evens, and if I can get the break even points like you just talked about, 111.20 to the downside, especially on this one because there's some nice support there. That is key to me, where that break even comes into what the expected move is.
Let's go over that real quick now, guys. It's the 121. hold on, let's call that up, because right as I do it, it disappears. We go on Disney. Now, there you can see it on the board. On the call side, it's the 121, 123. On the put side, it's the 112, 110 put vertical. Both short verticals, both taking in credits. And as you can see, you're creating the iron counter.
Yep.
All right, guys, let's take a quick break here. Coming up next, Ben Watson joins us for the Face-Off segment. He's going to talk healthcare. CVS, stay right here. The TD Ameritrade Network, Fast Market. We'll be right back.